Hi, and welcome to Module 2, Part 2 of Module 2, Project Evaluation. So last week we looked at the basic principles of evaluating projects. So we went from the discounted cash flow methods. We have the NPV method, the net present value method, to the internal rate of return method, benefit cost ratio. Then we talk about the non-discounted cash flow methods, being the accounting rate of return, for example, the payback period, and the economic value added method. So the projects that we looked at last week were quite simple. We compare projects with the same maturity, right? So if we have two projects, both of them are expected to run for 5 years, we simply just have to compare them based on the NPV numbers. The questions that we asked this week are a bit more trickier. So firstly, how do we estimate the expected cash flows of the project in the future? And second, if projects have different lives, how do we compare these different projects, right? So if the maturities of the projects are different, how do we compare the projects? Finally, not related to these slides, but for next week, we'll be looking at the impact of uncertainty on our estimates. So if we have uncertainty, right? So when we look at a project, the cash flows are expected to happen in the future. What if the future cash flows become more volatile, right? So in that case, how do we factor in the uncertainty in our estimates? So the purpose of this lecture is twofold. Firstly, we look at an application of the NPV method. So from the previous week, we apply the NPV method for a given project, right? So the cash flows of the projects are given. In this lecture, we look at how to estimate the cash flows from, say, for example, from a certain sales estimates or cost estimates of a project. We then look at different techniques to compare projects with different lives. So the learning objectives of this topic is firstly to understand the principles used in estimating project cash flows. So the method that we look at is called free cash flow analysis, and we'll explain why it's called free cash flow later on. We then compare mutually exclusive projects that have different lives. We then look at the decision to retire a certain a current machine, a current equipment, or to replace a certain equipment. So in this lecture, the first part of the lecture looks at how to estimate the cash flows of a certain project. So with the NPV method, the net present value method, the net present value of the project is given by the difference between the sum of the present values of future cash flows and the initial investment, right? So the initial cash outflow. So the question that we ask here is, how do we estimate the values of the future cash flows? So for example, so suppose that we were in 2006 and we wanted to open a Starbucks shop in the new university, which is the new space, right? When the construction finished. Suppose we could come up with reliable estimates for our future sales and the cost of our business based on the number of students or workers around here and based on what other coffee shops are doing. So the question here for us as an investor is to work out how much money do we expect from this investment going forward. So as an investor, say as a shareholder, how much would be distributed to us given our estimates of the future sales and the cost of the projects. So if we were to use the NPV method to evaluate this project, the first step that we have to do is to estimate the future cash flows. So this is the purpose of the lecture today. So an application of the NPV method is a free cash flow analysis where we try to work out how much money or what is the cash flow distributable to the financial supplier of the project or the firm. Yeah. So free cash flows are cash flows distributable to shareholders and debt holders, being the financial suppliers. Yeah. These are the shares of the suppliers, the employees, and the governments. Yeah. So we want to work out how much the financial suppliers get out of the firm's cash flows. So a question here is, given that we want to maximize the shareholders' value, we only care about shareholders' value, why in the free cash flows we include both the cash flows distributable to shareholders and the debt holders? Yeah. So you will see that from the calculation of the free cash flows, when we estimate the free cash flows, we don't deduct debt payments, right, out of our profits, out of our gross profits. Yeah. So what's the reason here? So the reason here is we want to work out the cash flows generated by the investment decision itself. So we don't want to contaminate our estimation of the profitability of the project with how we finance it. Yeah. So if the project is financed more by debt, of course the cash flows distributed to shareholders will be less after we deduct debt payments, right? But that deduction is not because of the investment decision, it's because of the financing decision. Yeah. And we want to distinguish these two decisions. Okay. Therefore, our assumption here is, if we were to isolate the investment decision from the financing decision, then at the start, when we evaluate the project, we assume that the projects are financed 100% by equity, right? So no debt payment here. So once we work out the profitability of the project, i.e. the cash flows of the project, we can then factor in our financing option later on. Yeah. So project evaluation is a two-step process where we evaluate our investment decision separately from our financing decision. So the principles of the free cash flow analysis are quite simple. So what we focus here in this method is we are focusing on the cash flows, right? So we only care about items that are cash, yeah? So we only care about the cash effects of certain items, right? So our free cash flows, or our cash flows distributable to the financial suppliers, let's ignore the debt holders at the moment. We're assuming that our firm is 100% financed by equity, right? So the cash flows distributable to shareholders in this case would simply just be the gross profits minus all the taxes plus all the tax credits from non-cash items minus our investment, right? So the commitment in the project minus our investment in the working capital, right? So this bit here is earnings before interest and tax. This is given by our sales or revenues minus production costs. Yeah. Okay. Then we deduct the tax expenses. So this bit here is a bit tricky, so we're going to illustrate the impact of depreciation on the tax payment later on. So depreciation is a non-cash expense, right? So in the free cash flow analysis, it shouldn't come into the calculation. The reason why it is here is only because it affects how much taxes the firm has to pay, right? So with the free cash flow analysis, what we care about here is we care about cash items. Yeah. So the first question that we ask is it a cash item or would it have an impact on the cash flows of the project? Yeah. Secondly, we want to focus on incremental cash flows, right? So the question here that we ask is, how much would the firm value change because of the project, right? Because of this particular project, yeah? So we care only about the cash flows that the project brings into the firm, yeah? Opportunity costs, we'll talk about that later on in the workshop. So opportunity costs are cash flows that are not generated from a certain project, right? So if I invested in a coffee shop using my current building, so currently if I'm renting the building to another company and I get like $10,000 a year in rental income, if I were to have my own coffee shop using the same building, then I have to give up the current rental income, right? So the current rental income is not generated from the coffee shop, but it's related to the coffee shop, because if I choose the coffee shop, then I have to sacrifice the $10,000 in rental income, yeah? So opportunity costs are foregone profits that happen because we choose to invest in a certain project, yeah? So these cash flows, although they are not related directly to the operation of the project, but it's affected by the project, yeah? Sunk costs. So sunk costs are costs that have already been incurred, or costs that would be expense anyway, regardless of which project that we choose, right? So for example, before I can choose a certain project, I have to hire a consultant who do market research and give me a list of possible projects that I can choose. So regardless of which project that I choose, that I pick from the list, I will have to pay the consultant anyway, right? So that's the sunk cost, because regardless of whether I choose project A or project B, the cost would already has been expensed, yeah? Okay. Exclude financing charges. So we mentioned before that we want to isolate our investment decision and our financing decision, right? So with the free cash flow analysis, when we estimate the cash flows, we only want to see the effect of the investment decision. Therefore, in the free cash flows, we don't account for any financing charges, right? So we don't account for any debt payments, so on and so forth. To account for the financing decision, we normally tend to adjust the discount rate, or the required rate of return that we use to discount cash flows, right? So with the cash flow analysis, the free cash flow analysis, our investment decision is reflected in our estimate of the cash flows, whereas our financing decision would be reflected in our estimate of the rate of return of the project, right? Which is not the scope of this course. This is for 2080, yeah? Allocated costs. So this is quite similar to sunk costs in the sense that it's going to be expense regardless of whether we choose to invest in a certain project, right? So allocated costs are things like head office expenses, service department costs, so on and so forth, right? So the main point here of the free cash flow analysis is that we want to take into account cash flows that are specific to the project, right? So cash flows that are generated because of the project itself, yeah? Okay, residual values. So suppose that we want to open a coffee shop. We have to invest in the coffee making machine, right? So suppose that we want to run the coffee shop for only 5 years. at the end of 5 years, we liquidate all the assets related to the coffee shop, right? So we sell the building, if we own the building, we sell all the machines, we sell all the inventory, and so on and so forth. So at the end of 5 years, I get out of my investment and I get back my cash, right? So when we decide to sell our machines or our equipment, then we have to work out the sale price at the end, right? Because it's the cash flow. It's a cash flow related to the project. When we make a sale, we might have to pay taxes if we make a capital gain, right? Therefore, we have to take into account the residual values of the machines and the equipment related to a project, right? Okay. Working capital. Working capital is a bit tricky to think about. So working capital are short-term assets and liability, like inventories, account payables, and account receivables, right? So with the working capital, the same principle applies. We want to take into account the cash flow effects of working capital investments, yeah? So if I have to invest in, if I have to run my coffee machine today, I need the cups, right? I need the plastic cups. So if I were to buy 10,000 cups, for example, that's my inventory. If I buy the cups, I have to pay money to my suppliers, yeah? So that will be a cash outflow for me. So working capital is therefore thought of as an investment, yeah? So this is a short-term investment in the project, yeah? So similar to capital investment, if we invest in something, that's a cash outflow for us, and therefore when we look at working capital investments, it's normally a cash outflow, yeah? Inflation. So similar to what we did in week 2 and week 4, week 2 and week 3, with the effect of inflation, we have to make sure that we're consistent in our treatment of inflation, yeah? So if our cash flows, if our estimates of the cash flows are in nominal terms, then the estimates of the required rate of return or the discount rate should also be in nominal terms, yeah? And vice versa. So if our cash flows are estimated in real terms, then the discount rate should also be in real terms. Depreciation and taxes. So we mentioned before that depreciation is a non-cash item, and therefore it should not be accounted for in our free cash flow analysis. But the tax shield on depreciation, because depreciation is an expense, we save some taxes on depreciation, right? So the tax deduction on depreciation therefore is considered cash inflow because it's how much we save in our tax payments, yeah? And finally, taxes, of course, we have to take into account taxes because the income for shareholders is on an after-tax basis, yeah? Okay. So, for example, let's look at the depreciation tax shield. Suppose that we have an investment where there is no depreciation. Our income is $1,000. Our tax rate is $30. This is the corporate tax rate. And therefore our net income, after tax income, is $700, yeah? If our depreciation expense is $200, what would happen to our after tax income, right? So our cash income is the same, $1,000, but our taxable income become only $800 in this case, yeah? So this is an expense, and therefore it's deducted from our taxable income, yeah? So the tax payable is therefore calculated on the on only $800, right? Not on $1,000 as before. And therefore, we can see that our tax payment is a bit less than before, yeah? So the net earnings after tax is therefore a bit higher than before, yeah? So without depreciation, our income after tax is only $700. If there is depreciation expense that we can claim, then our after-tax income becomes $760, right? So the $60, the difference in the income without depreciation and the income with depreciation is $60, right? This is what we call tax shield on depreciation, yeah? So the important point here is to remember that depreciation is not a cash item, but the tax implication of depreciation is a cash item, right? So to work out the depreciation tax shield, we take the depreciation expense times the corporate tax rate, right? Okay. Taxes and long-term and the disposal of long-term assets. So we talk about considering the residual values of certain assets or machines or equipment in our free cash flow analysis, yeah? Let's look at an example of the residual values here, right? So suppose that we have a machine. This is our timeline. This is the time that we start our project, yeah? Our project's life is 5 years, yeah? But the machine's life is 6 years, yeah? So we buy the machine when we start our project. Okay. We expect the project to run for 5 years, and therefore at the end of year 5, we liquidate the machine, yeah? So we sell the machine, and our expected sale price is $500. The value of the machine, the book value of the machine at the time that we bought it is $6,000. This is going to be depreciated using the straight line method, and the useful life of the machine is 6 years, meaning that at the end of year 6, the book value of the machine is expected to be 0, right? So it only has a useful life of 6 years. At the end of 6 years, we assume that it has no value, right? So this is our book value. Okay. The sale price that we expected, to sell at in year 5 is the market value, right? This is what we actually can sell at the end of year 5. Okay. So the question here is there any tax implication at the time of the disposal? Yeah. So given that our project has 6 years, the useful life of the project is 6 years. The book value of the project at the start is $6,000. We therefore can work out the annual depreciation of the project, yeah? So $6,000 divided by 6. Using the straight line method, the amount of depreciation every year is $1,000, yeah? So we sell the project at the end of year 5, right? The book value of the machine at the time of disposal or at the end of year 5 is given by the difference between the starting value and how much it has depreciated over time, right? So from year 0 to year 5, how much it has depreciated, yeah? So given that it depreciates by $1,000 a year, by the end of year 5, the book value therefore becomes $1,000, yeah? So I emphasize that this $1,000 here is the book value, right? So this is what written on the book. the market value is the actual price that we sell the machine at the time that we liquidate the project. Yeah. So the market value here is given at $500. Comparing the market value and the book value, we see that we're making a loss in this transaction, right? So we sell the project at $500, but we believe that the project is worth $1,000. Yeah. So this is a book loss, right? So with a book loss, instead of paying taxes, we receive a tax credit, right? So because this is a loss, right? So this is a negative cash flow. We receive a tax credit on the sale instead of a tax liability. Yeah. So assuming that our tax rate is 30%, our tax deduction is therefore the size of the book lots times the tax rate, right? So if we make a $500 lots, then our tax credit, our tax savings is therefore $150, right? So to sum up, the tax implication for a disposal of a long-term asset is as follows. If we make a loss, right? If at the time of liquidation we make a loss, then we get a tax credit or we get a tax deduction for our loss. Yeah. If we make a gain, however, this is considered a capital gain, and therefore we pay taxes on the gain, right? So the general rule is here. Our tax deduction, or the amount of tax that we have to pay, is given by the loss from the sale of the equipment times the tax rate, or in the case of tax payable, the gain on the sale times the tax rate, right? So let's look at how we can present a free cash flow analysis on a spreadsheet. So I suppose that in this case, we have an investment with a 5 years of life expectancy, right? This is our current time. This is time 0. This is when we decide to invest in the project. This is the end of year 5, yeah? So what have you got here? So the investment outlay or the cost of this project is $1,200,000. Every year, we expect the project to generate $300,000 in after-tax profits. At the same time, we estimate that our depreciation tax shield or tax savings is $60,000. Yeah, this is also an after-tax basis. At the end of year 5, this is when we liquidate our machine. We sell the machine for $100,000. This is the sale value, right? So this is the market value of the machine. We make a book loss on this sale, and therefore we get tax credits for the sales, right? And we work out that our tax deduction is $30,000. Yeah. So given these cash flows happening at different points in time, we can work out our net cash flows for each of the years, right? So at year 0, this is when we have to expense, we have to invest in the project. So this is a negative cash flow, yeah? Starting from year 1 onwards until year 5, we earn some cash flows, right? So all of these cash flows are positive. In year 5, this is our terminal year. besides the project's cash flows, besides the profits, we also have the liquidation of the assets. Yeah. So as a result, our cash flows look a bit different, right, in the terminal year. So with the terminal year, besides the regular cash flows, we also have the liquidation of the assets. Yeah. So if the discount rate or if the required rate of return or the K in the NPV formula is given at 12% per year, then using the NPV method, we can work out that the NPV of the project is $171,485. Yeah. So this is a positive NPV investment, right? So if this is an independent investment, our decision rule would be to accept the project. Yeah. Similarly, our IRR, or the internal rate of return, is 17%. If we compare that with the required rate of return from the shareholders, then the internal rate of return of the project is higher than the required rate of return, right? So we once again accept the project. Yeah. So last week we only looked at how to use the NPV method or the IRR method to evaluate a certain project. This week we look at how to estimate the cash flows over here, right? So to summarize, there are three types of cash flows that we have to be aware of in the free cash flow analysis. We have our initial cash outlay. This is our initial investment, right? So this is when we buy machines, we buy the buildings, so on and so forth. Also, before we start the project, we have to buy inventories, right? So raw materials, so on and so forth. So our investment happens in year 0, right? So this is the capital investment. This is the short-term investment in inventory, yeah? So year 0, okay? We then have our ongoing cash flows starting from year 1 to the end of the project, yeah? So starting from year 1, year 2, year 3, so on and so forth, right? So suppose that our project runs for 10 years, for example. Yeah. So our ongoing cash flows happen from year 1 until year 10, right? We then have our terminal cash flows. This is when we have our last cash flows for the project plus the disposal of long-term assets, yeah? And the recovery of the working capital investment as well. Okay. So this is when we have our last cash flow plus the liquidation cash flows, right? So we sell our long-term assets. We also recover, or we also sell our short-term working capital investment, right? Okay, so in the next few slides, we'll look at comparing projects with different lives. So suppose that we have two projects. Project A, for example, has 3 years, and Project B is expected to last for 5 years. Yeah. So the key question here is we want to know which one has higher value, right? If we were just to use the NPV method to compare these two projects, what would we do? We would calculate the NPV for Project A and Project B, and we take whichever project that has the high NPV, right? So that's the basic NPV method. So with Project B, obviously Project B has 5 years, and therefore we have 2 more extra cash flows compared to Project A, right? So it's natural that we would expect Project B to have a higher NPV, yeah? However, if we just apply the NPV method like that, what are we ignoring, right? So with project B, even though project B has 2 more extra cash flows, but it also takes 2 more years, right? It takes a bit longer to recover all our investments, yeah? So with project B, we have to wait for 5 years before we can liquidate all the assets and get back our investment. Whereas with project A, it has a shorter horizon, yeah? So just applying the NPV method or the IRR method, or any kind of project evaluation method to compare these 2 projects would ignore the maturity or the liquidity risk of these 2 projects, yeah? So how do we take into account the effect of the maturities of the project in the calculation, right? So one way that we can, one strategy that we can use to compare projects with different lives is that we will bring these 2 projects, somehow we would bring the maturities of these 2 projects to be the same, right? So we make adjustments to the maturities of the project so that we have 2 projects with the same maturity, yeah? So for example here, what we can do is we can assume that the projects are continue forever so that we have 2 perpetuities, right? So if we have projects that continue forever, they don't have maturity, yeah? So in this case, it's okay to compare the 2 projects, right? So the idea here, in terms of comparing projects with different lives, is that we're going to assume that projects are to be continued, to be replaced at the end of its economic life, right, with an identical project, yeah? So we can only make comparison, as we mentioned before, we can only make comparison if the 2 chains are of equal length, yeah? So if we have a 3 year project like we had before and a 5-year project, we can only compare these 2 projects if they have the same length, right? So what can we do? We can assume that the first project is continued for 2 more times. Sorry, for 5 more times. So with project A, let me redraw my timeline. So for example, we going back to the project that we had before. Project A has 3 years. Project B has 5 years, yeah? So to be able to compare these 2 projects, we have to make sure that we adjust for the maturities of the project so that they have the same length, right? So for example, with these 2 projects, what we can do is that we can assume that project A is to be repeated for 5 more times, yeah? For 4 more times, so that we have 5 identical project A, right? So this is 6, this is 9, so on and so forth, right? Okay. So we repeat project A for 5 times, so that in the end, we have a project with 15 years, yeah? Similarly, with project B, what we can do is that we can repeat project B for 3 times. So that in total, we once again have a project with 15 years in life, yeah? So in this case, if we extend these 2 projects up until year 15, we would then have 2 different projects with the same life, yeah, with 15 years in life. So once we do that, we can then compare the 2 projects NPV, right? So the example that we just went through before is what we call a lowest common multiple method, where we find the lowest common multiple of the two projects, and then we assume that we continue the project until the lowest common multiple, right? So in this case, it's 15. We also have a second method, which is called the equivalent annual value method. So with this method, we're calculating. We can think of this as a average, yearly value of the project, right? So we're comparing two yearly averages. The last method is the constant change of replacement in perpetuity. So in this case, we are bringing the project to perpetuity, right? So we assume that we keep repeating project A until forever, yeah? We do the same thing for project B. So because these two projects don't have a maturity, we then can compare the values of these two projects by calculating the value of the perpetuities, right? So the main point for these valuation methods is that they are used to adjust for the different maturities of different projects, yeah? Okay. So as we mentioned before, with the lowest common multiple method, we first find the lowest common multiple of the project, and then we simply repeat the project until we reach the lowest common multiple, right? So in this case, we have an example where project A has 6 years and project B has 9 years, right? So the lowest common multiple for these projects are 18, yeah? So using the lowest common multiple, we then repeat project A 3 times. So 6 times 3 equals to 18. And project B 2 times, right? So 9 times 2 is 18, right? So the chains of replacement would therefore be of equal length. Right. So how do we repeat projects, yeah? So this is what our assumption looks like. This is project A. Project A has 6 years, right? So let's look at the first 6 years. So in the first 6 years, when we invest in the project, in year 0, we spend money for our investment, right? So this is the investment, in the initial investment. For every year from year 1 to year 6, we get, say for example, we get a fixed cash flow per year. Okay. So this is how our project's cash flows look like. We have a cash outflow in year 0, and then for every year from year 1 to year 6, we have a fixed cash flows per year, right? Fixed positive cash flow a year. So it looks like an annuity, right? With n equals to 6, yeah? So if we were to continue, if we were to repeat project A for 3 times, this is the first time, yeah? Then at the end of year 6, this is when we have to replace project A with an identical project, yeah? So at the end of year 6, when we approach the end of year 6, we once again invest in the same project. So we once again spend money here. And then for every year onwards, from year 7 to year 12, we get C, right? So identical cash flows as before. Then once we reach year 12 again, we will repeat our investment, right? So we once again invest in the same project. We spend money. This is the cash outflow for us. And then every year onwards, from year 13 to year 18, we receive C. Yeah. So in year 18, because we reach our lowest common multiple, we stop investing. Yeah. So in year 18, we only get the last cash flow of the last annuity. Right. So this is how the cash flows of a constant chain of replacement looks like. Okay. So we have, suppose that we have an annuity to start with. Every year from year 1 to year 18, we will get C. Okay. So the same cash flows every year. And then at each of these points, so year 0, year 6, and year 12, we have a negative cash flow, which is our investment, right? And once again, these cash flows are identical, yeah, because we're replacing identical projects, yeah. We then calculate the NPV for all these cash flows, yeah. We do the same thing for project B. Project B has 9 years, right? So once we run out of 9 years, we then replace project B with an identical project so that it runs for 18 years, yeah? So once we do that, we then again have another project with 18 years, which is equal to the life of the first project, yeah? So once we do this exercise, we can then calculate the NPV of the second project, and then we can validly compare the NPV obtained from these two calculations, yeah? So this exercise basically helps us to adjust for the different maturities of the two projects, yeah? So with the equivalent annual value method, what we're calculating here is we're calculating an average annual cash flow of an annuity with the same life of the project, and the present value of this annuity or these cash flows would be equal to the net present value of the project, right? So the equivalent annual value is given by this formula. So if you look at this formula, this is basically just the present value of an annuity formula rearranged, yeah? So the present value of an annuity is given by this formula here. Right. For simplicity, I'll just be using I'll just be using K here to be consistent with this formula. Okay. So if we rearrange this equation, what do we have? So C divided by K is equal to PV divided by this whole thing, right? Okay. We then take K to the other side of the equation. So we have C equal to PV times K divided by 1 minus 1 divided by 1 plus K to the power of n. Okay. So we then bring K here into the bracket down here. we will get this equation on the left. Yeah. Okay. So this term over here is equivalent to this term over here. Okay. So the EAV, or the equivalent annual value, is simply just the cash flow in an annuity formula, right? Where the present value is equal to the net present value of the project, right? So it sounds a bit complicated, but you can think of it as an average annual cash flow that we get out of the project. Yeah. So C. Yeah, right. The present value of this annuity here is simply just the net present value of the project. Yeah. So this is a dollar value, right? This is an annual value that we get from the project. Therefore, the decision rule here is we prefer the cash flows, we prefer the project with the higher equivalent annual value, right? So let's look at some examples. Here we have two assets, yeah, asset A and asset B. Our initial investment of these two projects are given. So project A is $20,000, project B is $40,000. We know the expected annual profits. We assume that this is the after-tax annual profits or annual cash flows. We also know that project A runs for 3 years and project B runs for 5 years. Yeah. So with these projects, for every year we get $12,000 for project A. For every year we get $15,000 for project B, and therefore these are annuities, right? So we know that these projects are annuities. Yeah. We're given the rate of return, which is 10%. We're asked to pick whichever project, right? We know that they are mutually exclusive, therefore we can only pick one, right? So what do we do here? These projects have different lives, and therefore we can't just compare two NPV numbers, right? We have to do some adjustments. So what do we do here? Okay. So if we were to calculate the NPVs of project A and project B, project A gives us $9,800, around $9,800. Project B gives us a bit more, right? 16,000. Okay, but we know that we're biased here because for project B we have 2 extra cash flows, yeah. Whereas for project A we stop here at year 3, right? So we've got to do some adjustments here. So if we were to use the EAV method to compare these two projects, what would we do? Given that we calculated the NPVs for the two projects from before, we can then apply the EAV formula to work out the EAV for each of the projects, right? So applying the formula here, our required rate of return, K, is the same for two projects, 10%, yeah? N is the number of cash flows in each of the projects, yeah? So a project A has 3 cash flows, so N here is 3, right? Project B have 5 cash flows, and therefore N here is 5, right? So applying the EAV formula for these two projects, this is what we obtained. Because these two numbers are yearly numbers, right? So this is an average yearly average yearly return, dollar return of each of the projects. we can then compare the two numbers, right? They're all on a yearly basis, yeah? So based on this number, because the EAV of project B is higher, we therefore can decide to pick project B, right? Okay. Constant chain of replacement in perpetuity. So we mentioned before that one method that we can use is to take two projects to perpetuity, right? In which case neither of them has a maturity, yeah? So if they don't have a maturity, then we can compare the cash flows in these two projects just like how we compare two perpetuities, yeah? So for example, we have two projects here. We have a project with 1 year and we have a project with 3 years, yeah? So to use the constant change replacement in perpetuity, what we'll do is that for each of the projects, we'll assume that at the end of the maturity, we purchase the same machine or the same equipment again, and this happens forever, right? So at the end of the maturity of the project, we just repeat the same investment again and again until in perpetuity, right? So with the constant chain of replacement in perpetuity, say we have project A and we bring them to perpetuity, yeah? A has 3 years, for example, right? So we have many investments of 3 years, right? Many 3-year investments, okay? So to calculate the NPV of this perpetuity, we can use this formula over here. Where the NPV of the perpetuity chain of replacement is given by the NPV of one project, so the NPV of this bit over here, times this factor, right? Okay. So once again, N is the number of cash flows. So if we have 5 cash flows, if we have a project with 5 years, then we have 5 cash flows, yeah? K is the required rate of return, and NPV is just the net present value of one project, right? The decision rule here is we will pick the project with the higher NPV, right? Okay. So going back to our example before, on slide 27, we have two projects. Project A has 3 years and project B has 5 years, yeah? So applying the formula, NPVA is what we calculated before. So this is the NPV for a 3-year project, right? N is 3 cash flows. Discount rate was 10%, right? Project B, 5 cash flows, same discount rate, so 10%. This is what we calculated before. So 0, 1, 2, 3, 4, and 5, yeah? Okay. So the two numbers that we get here are the NPVs in perpetuity, right? So this is the NPV for a perpetuity, and therefore we don't have to worry about the maturity anymore. So we can compare these two numbers straight away, yeah? So we pick the one with the higher NPV, given that the NPV of B is about 44,000, NPV of A in perpetuity is only 39,000, right? So we pick project B. Okay. So to compare the three methods, so how are these related, right? We will see that the equivalent annual value is equal to the NPV in perpetuity divided times K, right? So what does it mean here? So the equivalent annual value gives us an equal amount of cash flows for every year throughout the project's life, right? Say if we have a project with 3 years, right? So this is the EAV for each year. Sorry, it's a bit hard to draw on here, so I'm a bit slow. Right, so with the EAV, it calculates an equal amount of cash flows every year for the life of the project, yeah? So these three cash flows for year 1, year 2, and year 3 are the same, right? For the NPV in perpetuity, it gives us the present value of this perpetuity, yeah? So suppose that we take the project in perpetuity, okay, and we calculate the EAV for each of the projects, for each of the repetitions that we do in the future. 6. So every year we would then, once again, we get the EAV for every year, right? So what does that look like to us? Okay. So if we were to repeat the project until perpetuity, and if we were to calculate the EAV for each of the replacements, then we'll see that the EAV is simply just the cash flows that we receive for every year until forever, right? Until perpetuity. Okay. So this looks like a perpetuity formula to us, yeah? These cash flows would form a perpetuity, right? And the present value of this perpetuity is given by the annual cash flows divided by the required rate of return, right? Which is exactly what we do here, okay? As a result, our NPV to perpetuity is equal to the EAV divided by the required rate of return, yeah? So only the method 3, only the perpetuity NPV shows the total wealth effect. The EAV here shows us the yearly, right? A yearly cash flows, not the total wealth. Yeah. Okay. Inflation, right? So what we've been doing here is we've been assuming that we repeat the projects into perpetuity. And all the cash flows are fixed, right? So every year we have the same cash flows. If we have inflation, it's likely that our cash flows in the future would be inflated, right? So the values of the cash flows in the future has to be higher. Okay. So as a result, for the chain of replacement method to work properly, we tend to use real values, right? So we tend to adjust for inflations, okay, to account for the fact that in the future, when we repeat the project, the cash flows are not going to be the same. So is the chain of replacement method realistic? So obviously, we're not expected to use the same machine or the same equipment 10 years down the track, right? So after 10 years, technology might change, and the same technology that we use today may be obsolete, right? So the chain of replacement method has some limitations, yeah? In that we assume that in the future, when we replace a project, we replace an equipment, we replace that with the same identical project, yeah? Okay. We then look at the replacement and retirement decisions. So with the replacement decision, we want to know which project that we should replace the current project with, whereas with the retirement decision, we want to know what is the optimal time that we should retire a certain project, right? So the principle here is the same. We want to choose the timing, or we want to choose a certain project to replace if the decision gives us the best value, right? So with all of the decisions that we deal with here, we are looking at the best value, right? So the question here is, what time, for example, what time is the best time to retire a project? Okay, and that is given by the NPV of the timing. Yeah. So with the retirement decisions, this is when we use an asset for some time, and then we decide to not continue the operation with the asset anymore. So in this decision, we are looking at when to sell the assets, right, and not replace it with anything else. Okay. So here the importance is the timing. Yeah. With the replacement decision, this is when we use the asset for some time, but now we don't know whether we should continue to use the same assets or should we replace that with a better assets. Yeah. So our decision rule here for the retirement decision is, once again, we want to choose the best time, right? The time where we have the best value. Okay. So the project should be should be retired if the NPV of all of the future net cash flows is less than 0, right? So if we continue to, say here is year 5, for example, we could, in theory, continue to use the same project for 3 more years. And we want to know when exactly should we retire, right? Should we stop the production or should we go on until year 8, right? So we should stop the production whenever the production does not bring any new value into the firm, right? So with the retirement decision, this is what we do. Suppose that we have a 6-year-old machine. We're given K, which is the discounted cash flows. We want to know when is optimal to retire the machine, right? So here we have 2 options. So we have 3 options. This is where we're standing. We could either sell the project, we could sell the machine today, and we get this much, right? So when we sell the machine today, this is how much we get in terms of the sale value. We could also run the machine for 1 more year. So we run the machine for 1 more year. We get $8,000 next year, and then when we sell the machine, we get $6,000. Yeah. Or we could run the machines for for 2 more years. So we will get 2 cash flows, one in year 7, one in year 8. But then when we sell the machine at that time, we don't get any value, right? So at this time, the machine is worthless, yeah? So we could think of this decision as comparing 3 mutually exclusive projects, yeah? If we sell the project today, we get one cash flow, which is $12,000. If we sell the project in 1 year's time, we get one cash flow plus the sale price, right? So we get two cash flows in year 1 in this case. If we sell the machine in year 2, this is year 0, year 1, year 2. If we sell the machine in 2 years' time, we get 3 cash flows. We get the first cash flow in year 1, we get the second cash flow in year 2, and we get the sale price, right, which is in this case 0. Okay. So our decision here is we want to pick whatever time that has the maximum value, right? So if we decide to sell the project today, we get $12,000, right? Meaning that if we decide to run the machine for 1 more year, we forego this $12,000, right? So if we decide to get these 2 cash flows, we forego the $12,000 here. Okay, so this can be thought of as the cost, right, of deciding to run the project for 1 more year. Similarly, if we run the projects for 2 more years, we are foregoing the sale price that we should have got in year 6, right? So the sale price that we should have got in year 6 therefore could be thought of as the cost of running the projects for either 1 or 2 more years, right? So based on that analysis, we would then compute the value of retiring the project in year 7 or year 8, right? Comparing to retiring the project today. Okay. So this is how cash flow look like. 1, 2. Okay. So this is year 6, year 7, year 8. So looking at just the 2 options of running the project for 1 more year and running the project for 2 more years, right? We established before that the cost of running the projects for 1 or 2 more years is the current value that we should have got from selling the project, right? So if we run the project for 1 more year, we get $8,000 in the cash flow plus the sale value of the project at the end of year 7, right? If we run the projects for 2 more years, we get the cash flow in year 7, the cash flow in year 8, but when we sell the machine, we get nothing, right? So the present value of the first option, retiring in year 7, would be the difference between the present values of these 2 cash flows and $12,000. The present value of the decision to retire in year 8 would be the difference between the present values of these 2 cash flows and $12,000, right? Which is what we're doing here. Okay. So using this logic, we then calculate the NPV of the decision to retire in year 7, and it gives us $727. Yeah. Alternatively, if we run the project for 2 years, this is our NPV, right? This is a negative number, meaning that if we run the projects for 2 more years, it's actually bad for the shareholders, right? So it reduces the shareholder value. So what's optimal here, therefore, is to retire the project in year 7, right? So we run the project for 1 more year, after which we then sell the project, then liquidate the project. Yeah. Okay. So the NPV of retiring the project in year 7 is positive, whereas the NPV of running the project for 2 more years is negative. Okay. Therefore, we decide to go with this option over here. Okay. Okay. Replacement decisions. So we went through calculating or evaluating the retirement decision before. Now we look at the replacement decisions, right? So for this decision, we use the constant chain of replacement method to evaluate the replacement decision. Yeah. When we think of replacement, we have 2 options, right? We could either replace the old machine with an identical machine, or we could update our machine by replacing an old machine with a new machine. Yeah. With identical replacement, our strategy here is to choose a replacement frequency that maximizes the NPV of a perpetual chain of replacements, right? So the same principles apply. We want to choose the best value option. Yeah. So for example here, we're faced with a decision to choose when to replace our machine. Yeah. Suppose that we have 5 years. Okay, so we can run the machine for 5 more years, right? This is the residual value of the machine at each of the years, right? So this machine will become worthless in year 5. Okay. These are the cash flows associated with each of the years. So if we run the machine for 1 more year, we generate 1 more cash flow, and by the end of year 1, when we replace the machine, when we sell the old machine, we get $16,000, right? If we run the machine for 2 years, we get 2 cash flows. The first one being $12,000 in year 1, the second one being the $500,000 in year 2. And when we sell the machine, we get $14,000, so on and so forth, right? So one thing to remember is for the cash flows, if you run the projects for 3 years, you get 3 cash flows, but you only get 1 residual value, right? If you run the projects for 4 years, you get 4 cash flows, but once again, you only get 1 residual value, right? So the residual value is the liquidation value, and therefore you don't get these values here. You only get 1 residual value, right? Which is at the time that you decide to liquidate the asset, right? So with non-identical replacements, we have the same decision as before, just that the difference here is that we choose a different one, right? So we choose a different machine compared to before. Okay. So the steps to work out when's the optimal time to replace an old machine with a new machine is as follows. So first we determine the optimal replacement frequency for the new machine based on identical replacement, right? So we want to choose the best time to replace the machine. Second, we then work out the equivalent annual value of the new machine at the time that we want to replace based on step 1, and then we compare that with the NPV of continuing to operate the old machine, right? So we should replace the old machine with a new machine when the NPV of continuing to operate the old machine is less than, for 1 more year, is less than the EAV of the new machine, right? Relevant cash flows. So as we mentioned before, the free cash flow analysis looks at incremental cash flows and cash flows that are only related to the project, right? So the question here that we want to ask is, therefore, would the cash flow occur only if the project is accepted? Yeah. An example of a cash flow that would occur regardless of whether the project is accepted or not is consultant fees, right? So before we choose the project, we have to estimate which projects are available. Therefore, this fee is occur regardless of whichever project that we pick later on, right? Financing charges, we talked about this before. Allocated costs and sunk costs, right? So not related to the project. Opportunity costs. So be careful here. Sometimes it can be tricky to work out the opportunity cost of a project. So to recap, let's look at some examples. So in this case, we want to determine the immediate effect of these decisions on the store's cash flows, right? So we want to focus on the cash flows. Yeah. So in the first case, we want to cut down on inventory because we anticipate that there's going to be a reduction in customer demand. So we used to invest, say for example, $10,000 before in inventory. Now we only need to invest $8,000, right? Meaning that we don't have to expense $10,000 anymore. We only expense $8,000. Yeah. So the impact on the cash flow would be to recognize the cash inflow of $2,000. Yeah. So we don't have to we save some cash on our inventory investment. Yeah. In the second case, we want to add some new products to the existing catalog to attract customers. So to add some new products, we therefore have to increase the inventory. Yeah. So this is a cash outflow because we need to invest more. Let's look at some other examples. So in this case, we want to replace some existing products with new products, right? So we still make the same quantity of sales, we just sell different things, right? Therefore, there's no change in the inventory, so same quantity, no impact, yeah? In addition, we want to increase the term of the interest rate free purchase. This would encourage people to buy on credit more, right? So when customers buy on credit, what happens is they don't pay for our products in cash immediately. They will pay in the future day, right? So what will be the impact on the cash flows? In this case, account receivables or sales on credit would reduce the amount of cash that we receive today, right? So for example, we make $10,000 in sales. If $2,000 out of this $10,000 is sales on credit, it means that we don't receive this $2,000 in cash, right? So in our calculation of the free cash flow, we therefore have to minus this $2,000 from our sales, yeah, to recognize that this is not a cash item, right? Finally, we can renegotiate with the suppliers so that we can have a better term on purchase, right? So basically we can extend the period that we have to pay back on our trade, yeah? So this effectively increases our account payables, right? So we buy on credit from our suppliers more. Okay. The impact of this on the cash flow is an increase in the cash flow, right? Suppose that we have to buy $10,000 in supplies. If we could buy this $10,000, if $2,000 out of this $10,000 is purchased on credit or trades on credit, it means that in the current period, we don't have to expense this $2,000, right? So this is not a cash item. And therefore, effectively, our costs, our production costs is only $8,000, right? So all these examples that we went through today does not mean that this is a savings for us, right? This is just a cash effect, yeah? So these items will be recovered in a future date, but we just recognize the time value effect on the cash flows in our calculation of the free cash flows, right? Okay. So this slide concludes part 2 of module 2, where we look at the free cash flow analysis, and then we look at different types of decisions where we have projects with different lives. We have the retirement decision, and we have the replacement decisions, right? So the emphasis of this lecture is on the free cash flow analysis. We then later on look at different investment decisions. For all of these decisions, our principle stays the same. We want to choose the timing of the retirement decision, or we want to choose a certain project to replace when the NPV of the decision is maximized, right?